This is a lecture from Open Tuition. To benefit from the lecture, you should download the free lecture notes from opentuition.com.
So, having looked at the basics of consolidation in the previous sessions and looked at two really good examples whereby we had 100% ownership, we're now just going to move things on just a little bit to look at what's referred to as the non-controlling interest. And non-controlling interest, it's going to arise within a question. It's not going to be that we have a full 100% ownership. But the key thing to understand, it is all about control, isn't it? And we said there that control is exerted if you have greater than 50% of the ordinary share capital or the equity share capital, the voting rights. Okay, because if you own greater than 50%, what happens is that you can pass an ordinary resolution within the business, and you only need to pass an ordinary resolution to be able to elect the directors. Now, if you can elect the directors, you will elect your directors, and if you put in place your directors, you will tell them what to do. If you're telling them what to do, you have control, don't we? Okay. So as long as you have greater than 50%, it doesn't necessarily need to be 100%. So you could have, say, as it's in the notes, 75%, which is greater than 50, which gives you the power to direct the activities. If that's the case, then you must still prepare your consolidated financial statements. Okay. Key situation. Remember when we spoke about the basic principles, was talking about control and ownership, wasn't it? So even if we don't own 100%, but own greater than 50, then we still have control, don't we? If that's the case, then all of the assets, all of the liabilities are consolidated 100% on a line-by-line basis. Don't put in 75% of the assets. Don't put in 75% of the liabilities. If you do that, you might as well forget about doing the rest of the group's question. Sacrilege. Okay, you can't do that. Yeah, if you have control, you control all of the assets, all of the liabilities. So therefore, we record them 100% in the group accounts. Got that? Good. Okay, because yes, even though we've shown control by adding across 100% of the subsidiary, we also then need to show ownership. Okay, so we need to show who owns that 25% interest. As we mentioned, I think a bit earlier in one of the previous videos, that's referred to as the non-controlling interest, so NCI, and ownership within the group account is always shown within equity. So there's going to be a new line item that we see, and that new line item is referred to as the non-controlling interest. Okay. The issue that we have is, how do we measure that non-controlling interest? How do we account, if you like, for this 25% ownership? Well, there are two ways in which we can measure it. So we're looking there at measurement. How do we record it as a number within our group accounts? The question will have to be clear, because depending upon which method we use will give us different figures. So what we've got there, first of all, is referred to as the proportionate share of net assets method. So if we own 75%, essentially we own 75% of the assets and 75% of the liabilities. So therefore, the non-controlling interest own 25% of the assets, 25% of the liabilities. So to work out the non-controlling interest, we will take the non-controlling interest share of the net assets of the subsidiary, the assets less the liabilities, because that is what the NCI own. So the key bit there is that we're taking our non-controlling interest share of the net assets. Okay. But the issue that you have there with regards to the net assets is that the net assets, the assets less the liabilities, in the subsidiaries' books are normally shown at their book value, aren't they? Now, book value doesn't represent what they are truly worth. You know, the true worth of a business is the share price, isn't it? And when we're talking about the share price, we're talking there about a fair value. So what we're going to go through and do there is, when we're looking at the fair value, we're going to look there at using S's share price, look at the number of shares that the non-controlling interest own, and value the non-controlling interest based upon the number of shares that they own and the value of those shares. Okay, so the value of a subsidiary share. Okay, so if you like, it's a little bit more of an exact answer, isn't it? A little bit more accurate, because it takes the true worth ignores any accounting policies or any accounting judgments that you may have when you refer to the net assets method. Okay, so it's key that you know the difference between the two, and it's important as well to be able to calculate the two. Okay, so what we're going to go through and do is we're going to go through and have a play around, is it with an example, a little example there, is it over the page, that goes through there and asks us to go through and prepare the consolidated statement of financial position. Is it for the Pierre group? So we know straight away there that Pierre's the parent. At the 31st of December 20x5, assuming the non-controlling interest is measured using the proportionate share of net assets method. Okay, so we're not going to use the share price. I don't even think there's given a share price in the question. We just use the net assets method. Okay, so it says there that Pierre acquired 80% of Stefan, so we have control. So we will consolidate. So we will add across all of the assets, all of the liabilities on a line-by-line basis. So in a moment, that will be our step one, won't it? That was done on the 31st of December X4, so that was at the end of the previous year. The retained earnings of Stefan, the subsidiary, are $750,000, so we'll be able to use that to work out the post-acquisition retained earnings. And I think you probably all spotted it already. The NCI that we have is equal to 20%, isn't it? Okay. So we need to account for that non-controlling interest share, don't we? So what you've got there is we know that we need to consolidate, add across the assets and the liabilities. The share capital, again, we're going to put in 100% of the parent share capital only. The investment that you have in the subsidiary, we ignore, don't we? We can also work out the retained earnings. We're not going to put it in as a balancing figure anymore. We know how to calculate it, don't we? 100% of the parent plus the parent share of the post-acquisition movement. And then we can play around with the non-controlling interest, can't we? Okay. That, if you like it, is going to be our step 4. So what I can do is I need a bit more space on this one, so I'll open up a separate page of paper. I'm going to head it up there, isn't it, with our group statement of financial position. Okay. And on the group statement of financial position, we've got there, is it our other assets. Okay. The other assets are there, is it as 1,900 plus, was it the 1,450? Remember, I've ignored the investment in the subsidiary. Does that give me 3,350? So when I total it up afterwards, there's nothing much else that's happening. That's 3,350. Again, if you so wish, that's step number 1, isn't it? Okay. We've also got there, is it your equity share capital? I'll put that in a moment. I'm just going to work through the steps in a fashion that we're used to. Retained earnings and non-controlling interest. Okay, so just leave yourself a bit of space between retained earnings and NCI in case we need to do any calculations. I say in case. I know we will need to do some. You can then total that up. That would give you your equity, wouldn't it? And then you have, is it your liabilities? Is that there the 500 plus 300, which gives me 800. Okay, and I know that should come to, is it 3,350 at the end. Okay. So let's just go through there and get the nice simple bits. Step number 2 is the equity share capital, isn't it? So that's 100% of the parent. Is that there as 1,000? So again, ridiculously straightforward. Okay. Did I say that group accounts was hard in the introduction? I think it just says it takes you a lot of time to get used to the mechanics. We then need to work out the retained earnings, don't we? Okay. So remember, the retained earnings is going to be 100% of the parent. So is that the 1,200? So we can put that in, can't we? Okay. That's the 1,200. To which We then add on our share. Is it 80%? So remember, we're talking about ownership, aren't we? So we own 80% of the subsidiary. We own 80% of the subsidiary's profit since acquisition. So that's 80% of the profits. Well, the profits at year end were 900. But we don't own all of them, do we? Because we paid to acquire this subsidiary. We haven't owned it since incorporation. So since we've owned it, well, at the date of acquisition, the profits were there at 750,000. And if you tap that into your calculator, just check. My arithmetic is never the greatest. That gives me, is it 1320? Okay. So that's, again, just so you've got it in, is that 100% of P. And then that is it, P share of S's post-acquisition movement in retained earnings, which essentially, as there are no other reserves, is just a movement in net assets. Okay. In this exam, there's never ever going to be any movement in the share capital. Whatever it was at the acquisition date, it will be the same as at the year-end date. Okay. If you wanted, you could potentially go through and cheat, I think, and work out what the non-controlling interest is as a balancing figure. So what have we got? 3350 less 800. Does that give me 2550? So my equity is 2550. If I take the 2550 and deduct 1,000 and deduct 1320, that should give me, is it 230? Okay. I have cheated in this instance and thrown it in as a balancing figure. What I need to do is to demonstrate how we get to that figure. Okay. Because we've gone through there and measured it based upon the proportionate share, is it, of net assets. Okay. So what we need to do is we need to get to, was it that 230 figure? Okay, let's just check. Yeah, just squeezed in there. Okay, the 230. So we're going to go through there and work out the non-controlling interest. We're going to work the non-controlling interest on your proportionate share of net assets method, aren't we? Okay. So the way in which we're going to go through and calculate it is that we look at the non-controlling interest at the date of acquisition. Okay, what was the non-controlling interest when we bought the subsidiary? Well, the non-controlling interest is 20%, isn't it? Okay, and we're going to use the net assets at the acquisition date, which we don't actually know, do we? Because we're given the net assets within the question based upon the year end, aren't we? December X5. We need to work out the net assets at December X4. Well, we know the retained earnings are 750,000. We can see it up there, can't we? Okay. We just said a moment ago that the share capital remained unchanged. And if you take share capital plus retained earnings, using the accounting equation, that equals your net assets, doesn't it? Remember, share capital plus retained earnings is equal to your assets less your liabilities, isn't it? It is. Okay. So what we've got there is we can go through there and take the share capital, which was, I think, 250. So even though that's at the end of the year, it never changes, so it'll be in the same acquisition. We add on, is it the 750? So we've got the 250 plus 750 is that 1,000. 20% of 1,000 is 200. Ooh. We need the non-controlling interest to be 230. So we need to magic up a figure, don't we, of 30. Okay. Where does that come from? Well, we've worked out the non-controlling interest at acquisition based upon the proportionate share of net assets. So we've looked at that at the acquisition date. What we then need to do there is we need to look at how that subsidiary has then traded. Because as the subsidiary has traded in the post-acquisition period, it has made profits. And the non-controlling interest own their share of S's post-acquisition movement in those profits, or if you like, in the movement in the net assets. So what you have there is the non-controlling interest is 20%. The post-acquisition movement is the same calculation that we looked at a little bit earlier on, isn't it? Okay, that 900 less the 750 is when we went through there and worked out S's post-acquisition. We gave P's share of those post-acquisition profits in the sub in the group retained earnings, because that is what the parent owned of the group, isn't it? Okay, now we're taking the same post-acquisition profits and looking at what the non-controlling interest own of those post-acquisition profits. Okay, they own 20%, is it, of the 150, which is the movement, isn't it? So the movement from 900 when it was originally 750, and 20% of that is there as 150. Okay, sorry, 20% of 150 is then the 30, isn't it? Adding that together gives you, if you like, the non-controlling interest. Apologies for that. At year end. Okay, the NCI at year end. Okay, there we go. So there's quite a bit that we've taken on board so far. So what I'll just do is I'll just do a quick summary. Okay, a summary of the calculations. So there's nothing there contained within your notes, so it may be worthwhile you putting it in. We're going to summarise, is it the group retained earnings, so GRE for short, and then on the other half of your page we can look at the non-controlling interest. Okay, now essentially this is a summary all about the ownership section, isn't it? Okay. So the group retained earnings, remember we put in, is it 100% of the parent, to which we then add on, is it P's share of S's post-acquisition figure. Okay. Essentially that's what the parent owns, isn't it? It owns all of its retained earnings. And it owns its share of everything the subsidiary has generated in the post-acquisition period. The non-controlling interest, it doesn't matter whether it's proportionate share of net assets or fair value method. You take the non-controlling interest at acquisition. So again, that will be either based upon the fair value or, if you like, your percentage of net assets. Okay, to which you then go through there, don't we, and add on the non-controlling interest share of S's post-acquisition. Again, the figure that we have, is it there for S's post-acquisition, is the same figure that we use in each of those calculations. And for now, it just looks at the movement, doesn't it, in your retained earnings. So there, the figures that we're going to go through and calculate is that we take, is it the retained earnings at year end, and we deduct, is it the retained earnings at the date of acquisition. That looks at your post-acquisition movement. Okay. Hopefully you've gone through and understood all that and are happy with it. If you're not, before you go through and attempt any questions, work it through. Yeah, rework the basics of consolidation. So adding across 100% of P, 100% of S, putting in 100% of the parent share capital only, putting in the retained earnings as a balancing figure, but think more now about how you can calculate the retained earnings using that formula there. Okay. Now we then moved it on, didn't we? So that we may own more than 50% but not have 100% ownership, which brought in now to the equity section that non-controlling interest. Okay, be able to calculate the non-controlling interest. We've looked at it based upon a percentage of the net assets, so the NCI share of the net assets. If it's there based upon fair value, which I'm sure it will appear, and we will see it in some questions later on, but to work it out based upon fair value, you look at the non-controlling interest percentage of S's number of shares, because that's what the non-controlling interest own, isn't it? Okay, they own their percentage of S's shares, and then you just multiply that by S's share price, and again that share price needs to be there at the date of acquisition. Okay, and whatever figure you have, you then just adjust that, don't you, whereby you will then add on the non-controlling interest share of S's post-acquisition profits. Okay, there you go. If you're happy with it, brilliant. Let's move on and we'll go through there and see goodwill in the next session. If you're stuck, feel free to ask a tutor and we will be there ready and willing to go through and help you out.